Have you ever stared at your trading screens, perfectly lined up your crosshairs, clicked buy, and immediately, within milliseconds, wished you had an undo button? The market hasn't even moved half a pip yet, but a sinking feeling in the pit of your stomach tells you that you have just made a terrible mistake. The moment your brain shifts from cold, calculated logic into emotional survival mode, your trade is already dead. There is a massive misconception in the retail trading industry. Most traders think a bad trade starts when the candlestick crosses the red dotted line and hits your stop loss. They believe a trade only becomes a failure when the broker deducts the funds from their account balance. Because of this, traders spend all their time analyzing the charts after the loss, trying to figure out what technical indicator they missed or what trend line they drew incorrectly. But this is completely backward. A bad trade does not start at the stop loss. A bad trade actually starts the exact moment your psychology deteriorates while the position is still open. When you enter a forced, oversized, or impulsive trade, you experience what is called a mid-trade meltdown. In an instant, you downgrade from being an objective, data-driven analyst to a desperate gambler trapped in a burning building. You are no longer managing risk. You are actively fighting your own nervous system. You stop reacting to the live market data and start reacting purely to your own internal panic, fear, and desperation. When you understand this, you realize that the ultimate indicator of a doomed trade isn't a technical pattern. It is your own internal behavior. If you can learn to read your own psychological red flags, you can abort disastrous trades before they drain your equity. Here are the 7 psychological signs that indicate your open position is doomed to end badly, and the proof that you are currently fighting your own panic, not the market. Before you enter the market, you are in total control. You sit back in your chair, draw your liquidity zones, map out your Fibonacci retracements, and wait patiently. When the price action finally approaches your zone, you feel like a sniper. You convince yourself that the confluences are perfect. You calculate your risk. You place your crosshairs over the execution button, and with absolute, unwavering confidence, you click buy. You expect to feel a surge of professional validation as the trade begins to play out. But the absolute second the order fills, and you hear that terminal chime, something goes terribly wrong. Instead of feeling calm and collected, a heavy wave of dread washes over you. Your gut drops to the floor. The chart hasn't even printed the next 1-minute candle, yet you instantly feel like you've been punched in the stomach. You immediately wish you hadn't taken the trade, and you find yourself staring at the screen, desperately wishing your broker had an undo button. Why does this happen? How can you go from absolute confidence to absolute terror in a fraction of a second? It happens because, subconsciously, your brain is processing vast amounts of information that your conscious ego chose to ignore. Deep down, in the back of your mind, you knew this was a low probability setup. You knew you were chasing the price because of the fear of missing out, FOMO. You knew you had oversized your position to try and win back yesterday's losses. While your ego was busy rationalizing the trade with indicators, your nervous system knew the truth. You were breaking your own trading rules. The moment the capital is officially at risk, the illusion shatters, and reality hits you like a freight train. The market didn't prove you wrong yet. Your nervous system did. You must learn to trust that immediate gut drop. If your first instinct post-entry is instant regret, the trade is mathematically and psychologically dead. Do not wait for the stop loss to validate your fear. Close the position manually, take the tiny spread loss, and protect your mental capital. Let's say you stay in the trade, and the price starts to drift against you. Your position goes into the red. At the surface level, you try to play it cool. You tell yourself, it's just a standard pullback. The market doesn't move in straight lines. It's just retesting the breakout level. You try to maintain the facade of a disciplined trader, watching the price action and waiting for the inevitable bounce. But as the red floating loss gets larger and larger, that facade begins to crack. You completely abandon market logic. You stop looking at the structural highs and lows. You stop caring about the volume profile or the fundamental news drivers. You transition out of the role of an analyst and enter into the bargaining phase of grief. You literally begin negotiating with the trading gods. You catch yourself staring at the red candlestick and thinking, or even whispering out loud, please just go back to my entry price. If you just go back to break even, I swear I will close this trade. I promise I will never over-leverage again. I will never take a trade outside of my session again. Just let me out of this one alive. You are no longer a trader managing a financial asset. You are a hostage, pleading with the market for your release. You are willing to say or promise anything just to make the emotional pain stop. Here is the harsh, unexpected insight that you must accept. The market doesn't know or care where your break-even is. Your entry price is a completely irrelevant, random coordinate to the global algorithms and institutional algorithms driving the liquidity. The chart doesn't owe you a clean exit just because you feel pain. The urge to pray for break-even is a deeply flawed illusion. The second you start negotiating for a break-even exit, the original thesis of your trade is dead. You are just trying to escape a burning building. The trade is now heavily in drawdown. The pain of the floating red P&L is becoming unbearable, and your brain starts frantically looking for a shortcut to alleviate the stress. Suddenly, you have a dangerous, impulsive idea. What if I just add another position down here? You rationalize it quickly. If I buy more right now, at this lower price, I will drastically improve my average entry. That means the market doesn't even have to go all the way back up to my original entry. I just need a tiny, little relief bounce, and I can close both positions out at break even. In your panic state, this sounds like a stroke of genius. But let's look at the actual risk you are taking. You are taking a trade setup that is actively failing, a thesis that the market is actively proving wrong, and you are choosing to exponentially compound your financial exposure to it. You are literally doubling down on a proven bad idea, completely obliterating your daily risk limits in the process. You might try to justify this to yourself by calling it scaling in or dollar cost averaging. But let's be brutally honest. Was this in your pre-trade plan? Did you write down, before you entered the market, that you would add a second lot at this exact price point? No, you didn't. You aren't executing a strategic, multi-layered entry. You are throwing more money at a bad idea purely out of frustration and ego. It is a desperate attempt to manipulate the math so you don't have to admit you were wrong. It is revenge trading disguised as strategy. Never ever try to fix a losing trade with more size. A bad trade is not a broken engine that can be repaired with a wrench. It is a tumor that can only be cut out. The moment you feel the impulse to average down on a losing position that wasn't planned, you have entirely lost emotional control. Cut the trade immediately. Think back to the moments right before you entered this position. You had a crystal clear mechanical thesis. You were looking at the 15-minute chart. You identified a strong demand zone. You saw bullish divergence on your oscillator, and you waited for a 15-minute bullish engulfing candle to close. Your thesis was perfectly defined. I am buying the 15-minute support bounce, and if the 15-minute candle closes below this zone, my thesis is invalid and I exit. Now you are in the trade. A massive red candle prints, and the 15-minute support violently breaks. The candle closes well below your zone. The exact condition for your invalidation has been met. The thesis is unequivocally dead. But instead of accepting the loss and clicking close, your panicked brain scrambles. It refuses to accept the pain. So, you start clicking through the time frames. You jump up to the 1-hour chart. Okay, you tell yourself. The 15-minute broke, but the 1 hour is still holding the 50 moving average. It's fine. Then the 1 hour breaks. You panic again, clicking over to the 4-hour chart. Well, the 4 hour is just testing the golden pocket Fibonacci level. This is actually a great swing trade now. Take a step back and look at what you have become. You are now holding a massive, losing position based on an entirely different set of rules, indicators, and time frames than the ones you used to enter. You have contracted thesis amnesia. You are no longer trading a high probability setup. You are frantically hunting for excuses to delay taking the loss. Here is a profound truth about trading psychology. The more time frames you check mid-trade, the closer you are to a blown account. A calm, professional trader trusts the time frame they entered on. If the 15-minute setup fails, they take the 15-minute loss. But a panicked retail trader will click through the 1-minute, 5-minute, 1-hour, daily, and weekly charts, desperately seeking any combination of indicators that will give them false hope. If you are changing your time frame while the trade is live, the trade is already a disaster. The market is merciless. It doesn't care about your 4-hour Fibonacci levels. The price continues to drop, creeping dangerously close to your hard stop loss. You are staring at that red dotted line on your MetaTrader terminal. You know that if the price touches it, the loss becomes real. The money is gone forever. So, what do? As the price gets within 2 pips of your stop loss, you click the line and you drag it down. You nudge it just a little bit wider. 10 minutes later, price drops again, and you drag the stop loss down again. If I were to ask you why you just did that, your ego would immediately generate a logical-sounding excuse. You would rationalize this highly toxic behavior by saying, it's just a liquidity sweep. The market makers are just hunting retail stops before reversing. It's just a wick. It just needs a little more room to breathe. You convince yourself that moving the stop loss is an act of advanced market understanding. You tell yourself you are just outsmarting the algorithms. But that is a complete lie. The chart doesn't need room to breathe. You do. You are suffocating under the immense psychological weight of an unaccepted loss. The real cause of the stop-loss nudge has absolutely nothing to do with market structure or liquidity sweeps. It is entirely about your fragile ego. Your ego simply cannot stomach the reality of being wrong. You have attached your self-worth to the outcome of this specific trade, and you are literally willing to risk your entire account balance rather than admit to the market that your analysis was incorrect. You aren't refusing a stop-loss. You are refusing reality. You must accept a fundamental law of risk management. Your original stop-loss was placed by the calm, rational, objective version of you before you had money on the line. The person dragging that stop-loss wider is a panicked, emotional, irrational gambler. You must honor the logic of the analyst, not the emotion of the gambler. If price hits your invalidation level, let it take you out. Accept the reality, preserve your capital, and live to trade another day. Let's look at the opposite scenario. What happens when the trade actually starts going your way? You enter the position, and almost immediately, the market pushes into the blue. You are in profit. You would think this is where the anxiety stops, but for the panicked trader, the tension actually amplifies. Because you don't truly trust your edge, and because you are terrified of the market suddenly turning around and taking your unrealized profit away, you cannot look away from the screen. The internal anxiety is suffocating. You are staring at every single tick on the 1-minute chart, holding your breath, waiting for the inevitable reversal. This unbearable tension leads directly to micromanagement. Your original trade plan dictated a 1-to-3 risk-to-reward ratio. Your take profit is set 60 pips away. But the moment the trade goes 10 pips in profit, you panic. You impulsively drag your stop-loss right up to break even way too early, terrified of letting a green trade turn red. Or worse, the price hits a minor 1-minute pullback, your heart skips a beat, and you slam the close button. You snatch a tiny, meaningless 15-pip profit, entirely abandoning the 60-pip target you spent hours analyzing. You lean back in your chair and let out a massive sigh of relief. You made money, right? The trade was a winner. But let's analyze why you actually closed it. You didn't take that profit because the price hit a major structural resistance level. You didn't move your stop to break even because the market broke market structure and created a new higher low. You took that action for one reason, and one reason only, to make the internal mental tension stop. You clicked close because the psychological pressure of holding the position was too heavy for you to carry. Here is a brutal truth that separates the amateurs from the professionals. When you micromanage a live trade, you aren't managing the market. You are managing your own anxiety. You are essentially paying a fee to the market, in the form of massive lost potential profits, just to buy back your own peace of mind. By moving your stop to break even too early, you guarantee you will be wicked out right before the massive move happens. By taking 10% of your profit target, you destroy your risk-to-reward math, guaranteeing that your eventual losers will mathematically destroy your account. If your heart is pounding and you are suffocating the trade, you are trading too large, or you don't trust your edge. Good trading should feel incredibly, remarkably boring. Finally, we arrive at the ultimate red flag of a doomed trade. The trade is active, it's hovering in the red, and the uncertainty is eating you alive. The exact moment the pressure peaks, your eyes dart away from the MetaTrader terminal. You open a new browser tab. You immediately go to Twitter, X, open your trading Discord, or pull up a Reddit forum. You start frantically typing in the ticker symbol you are currently trading. USD analysis, gold price prediction today. You are rapidly scrolling through feeds, looking for anyone posting a chart that aligns with your position. Take a moment to step outside of yourself and investigate what you are actually doing in this moment. You aren't watching the live market data. You aren't looking at volume, order flow, or price action. You are actively searching the internet for a stranger with an anime profile picture to tell you that buying gold at the top was a good idea. When you find a post that says, "Gold is going to the moon today," you feel a temporary hit of dopamine. You feel a fleeting sense of relief. You tell yourself, "See, this guy agrees with me. I'm just going to hold the position." Why do you do this? Because you are desperately seeking external reassurance. The cause of this behavior is that your own internal conviction is completely gone. You don't actually believe in the technical validity of the trade anymore. Deep down, you know the setup is failing. But your ego refuses to accept the loss, so you are outsourcing your conviction. You want someone else to believe in the trade for you. You want someone else to validate your bad decision so you don't have to feel responsible for the impending loss. The solution to this is absolute and uncompromising. If you have to ask someone else if your open trade is good, it isn't. Period. If you lack the conviction to hold the trade based solely on your own predefined technical analysis, you have no business being in that position. The moment you open Twitter to look for validation mid-trade, the trade is dead. Close the position, take the loss, close the browser, and reclaim your emotional control. When you experience any of these 7 signs, whether it's the instant regret, the desperate bargaining for break-even, or the frantic search for validation on Twitter, you are experiencing a mid-trade meltdown. You are no longer trading the market. You are actively fighting your own panic. So, how do you fix this? How do you stop these emotional meltdowns from slowly bleeding your account dry? If you struggle with these mid-trade meltdowns, relying on willpower isn't enough to fix it. Willpower evaporates the second real money is on the line. As a former prop firm data analyst, I had unrestricted access to the back-end servers. I studied the raw data of thousands of traders to find the exact mathematical and psychological differences between the 1% who get massive payouts and the 99% who blow their accounts. I packed all of that classified data into a step-by-step book full of practical, mechanical strategies to permanently control fear, greed, and overtrading. Stop treating this profession like a casino. Grab the book via the link below to learn the exact mindset shifts the consistently profitable pros use to survive and thrive. But mindset takes time to build, and you need protection right now. To physically stop yourself from making these emotional mistakes on the live charts, you need a mechanical safeguard, the Alpha Equity Manager for MetaTrader 5. This isn't just a position calculator. It is a risk control terminal built for manual traders. It features a time-locked vault that literally blocks you from changing your max drawdown limits or lot sizes during your active trading hours, completely neutralizing your ability to self-sabotage. With its built-in stop-loss police and instant auto-closure of any rule-breaking trades, it forces ironclad discipline on your account exactly when your emotions try to take over. Stop fighting your own panic. Let this tool protect your capital automatically. The link to download is in the description. Identify the signs, cut the bad trades early, and protect your capital at all costs.